Hello, everyone. Welcome back to Financial News in Palos Heights. And, of course, I'm Ron Jankowski with Channel 4, and we have Paul Munico from Ameriprise Financial. And today being September 30th, 2019, Paul, I'll let you take it.
Thanks, Ron. I wanted to give the viewers watching the tactical updates that Ameriprise has for the fourth quarter. And what we have is Global Asset Allocation Committee made several adjustments to its tactical guidance as the final quarter of the year is approaching. With the third quarter nearly complete, large cap U.S. stocks currently sit near their all-time highs, thanks in part to the outperformance of several cyclical areas across the U.S. economy this year. At the exact same time, recession risks are intensifying, corporate profit growth around the world is slowing, and geopolitical frictions are increasing. Now that's destabilizing investors' confidence about the future. Manufacturing activity across the globe has further contracted in Q3 as well, which has led to the slowdown in economic output over recent months. Combined with a U.S.-China trade war, which intensified back in August and is pressuring trade activity across several large regions this year, many of the world's central banks recently decided to ease monetary policy as a means to help support growth. In many respects, the investment environment remains as uncertain today as it did at the start of the third quarter. Now, the market's large unknowns, the things we've talked about in the past, trade wars and growth, remain unknown still and continue to give us a pause. So as investors position for the final quarter of 2019, again, we've made changes to our global asset allocation strategy to further diversify our clients out. And if you want more information specifically on that, feel free to give me a call directly. It's not something suitable for over the year because that is different for every different investor out there. But I just want the viewers to know we have made some changes.
Okay, and Ameriprise Financial also gave us the need-to-know information this morning. The S&P 500 Index futures are slightly higher ahead of the final trading day of the third quarter.
That's warranted. I mean, last week we've seen some downside in the market last week. No real reason for it. So to see a slight bounce back this morning, it's normal.
They also mentioned the yield on the 10-year Treasury is holding near 1.7% as investors monitor the trade negotiations with China and the impeachment inquiry into the President Trump.
Yep, so we know the Fed cut rates recently, bringing yields, affecting yields, could affect your mortgage rates if you're looking to purchase or refinance, so maybe something worth investigating.
It might be worthy of investigating, exactly. It'll lower your cost a little if you spread it out over a period of several years.
Sure.
Also, they mentioned that the oil is lower this morning as slowing Chinese growth continues to fuel concerns over the demand, and that's good for us.
It's good for oil, but that's a big concern for the global economy.
Yep.
We don't want China to slow, and this is another indication that they might be slowing. So take note of that. It's great for the oil prices, but maybe not so great for the world economy.
For the global, concern. And just a specific on Anheuser-Busch and Budweiser APAC listing traded higher by more than 3% in the public debut in Hong Kong. Lots of things going on in Hong Kong.
I guess they're drinking beer in Hong Kong. Yeah, I don't know.
It makes the news. Financial news, you can't believe it. Okay, and then lastly, we want to share with you the S&P 500 is a plus 19% year-to-date. Still holding, Paul.
It's a big number.
And the Dow Jones is a plus 17% year-to-date, and the NASDAQ is a plus 20% year-to-date.
I mean, those are all massive numbers for 9 months of the year. As you said, hopefully we can hold that throughout the end of the year.
Yeah. Well, those are good parts of the financial news anyway.
Yep.
So stay with us. We'll be right back. Paul will be bringing a show called Your Money. He usually brings a topic that's of a lot of interest. Stay with us. We'll be right back. And we're back with the show called Your Money. Paul usually gives us some information on a particular topic for those that are, I would say, mid-range investors, and maybe anybody should be
Anyone,
looking
yeah.
at their portfolio with some of the topics that you bring up. Today is going to be diversification, and boy, is that important.
Yep. We talk about it in all our shows. We talk about asset allocation and diversification. So we figured, why don't we break it down a little bit for the viewers at home so that they
You could
know what those
explain
terms
maybe
mean.
what asset allocation actually represents. What does that mean?
Perfect. So asset allocation, it's a fancy word for a real general term. Like all it is the percentage you own between stocks, bonds, and cash. That's all asset allocation is. How you're allocated between those three areas: stocks, bonds, and cash.
And of course, the reason for that is
Well, you want to spread out risk. So
exactly.
if you're 19 years old and planning for retirement, I don't know, potentially you'd be 100% stock because you got years and years of growth. But an older retired individual still may need growth, but not as much. Their percentage of stock may go down. Their percentage of bonds and cash may go up.
Of course, if you're younger and you put a lot of your investments in stock, and you can't handle that at night, watching the stock market vacillate up and down, which is a normal thing for it to do,
Yep.
then maybe you should be more diversified.
Yeah, so diversification, now that takes it a step further. So asset allocation, stocks, bonds, and cash. Diversification is what types of stocks do you have? What types of bonds do you have? And cash is relatively cash. So you can go real deep into diversification, but just know it's spreading out those assets that we talked about. So for example, stocks, there's large cap stocks, medium sized stocks, small cap stocks, there's international stocks, emerging market stocks. The list goes on and on and on. That's just for stocks.
So you really need to know what is right for me.
Exactly. So you want to start with your asset allocation. As Ron mentioned, what percentage of stocks are you comfortable with? Because that's giving you risk. Of course, bonds give you risk too. They're not guaranteed. So first you got to figure out your asset allocation. Then within there, it gets real complicated because there's so many different types of stocks and bonds to invest in to further diversify you out.
And that's where a financial advisor should be in to help guide you through that whole process.
Exactly. It all depends on what you need for your portfolio. So you can have, let's say your asset allocation is 50% stocks, 50% bonds. But of your 50% stocks, you own just AT&T. That is ultra high risk. That is not a balanced portfolio that a 50-50 allocation should be. So that 50% in that example that's in stocks needs to be diversified across the spectrum of investments, if that's the right thing for you.
Well, also, we talk about investment objectives, and I think you need to maybe break that down. When you're looking for a certain return, basically, and you have to be in the right investment portfolio to achieve that. So you might want to
Absolutely, yeah.
go into that.
So investment objective just kind of helps your advisor with what you're looking for, whether the main objectives we see are investing for income, investing for growth, or investing for growth and income. Most people fall into that category because they still need their money to grow, to keep up with inflation over the years and potentially increasing, who knows, medical costs or what may be out there. But they also need income to help pay the bills during that time frame. So growth and income is a common investment objective we see, but there are people investing strictly for income, those investing strictly for growth, and all the places in between. So we can't say it enough. You've got to meet with an advisor to help you determine, beginning with the right, investment objective, then the right asset allocation, and then diversifying amongst the right investments.
Perfectly explaining the structure, the way it should work. Paul, is there anything that you want to close on this topic?
Just it's something to get right. A big percentage of your return comes from the proper asset allocation and the proper diversification. A lot of people will spend hours upon hours upon hours researching stock, and that's great, and you do need to do that, but that one stock that you research is just a minor holding of a much greater diversification and asset allocation. If those are not set properly to you, the individual stocks you pick really won't perform as much as you think they will to your portfolio. So you got to get the foundation and the framework right, and then you build into that what you're looking for.
If there is a question that a viewer may have, you want to give your ID?
Absolutely, and there should be questions on this topic. So viewers after this, they should be calling their advisor, making sure their allocation is proper to them. And if you're doing it at home by yourself, all these online sites have ways to spit out your asset allocation diversification. You should be reviewing that at all times. And in fact, the first half of the show, we talked about how Ameriprise is recommending changing your diversification a bit right now. But if you don't like doing it by yourself, and if you wanted a second opinion to who you're working with, or if you're not working with anyone, feel free to give me a call. You can call me directly at 708-226-3412. I'm happy to help.
Paul, thank you for bringing that to the viewers. For Paul Municle from Ameriprise Financial and myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.